You have probably heard the term IPO thrown around on the news, on financial apps, maybe even in casual conversation. But if you have ever found yourself nodding along while secretly wondering what it actually means and why it matters, this video is for you. We are going to break down everything you need to know about initial public offerings, from what they are and how they work, to what the current market looks like and where experts say things are heading next. So let us start from the very beginning. An initial public offering, or IPO, is the process through which a private company becomes a public company with publicly traded shares. According to financial institutions like Charles Schwab, an IPO signifies the first time a stock is made available on a public market through an exchange like the New York Stock Exchange or the Nasdaq, allowing any investor to buy and sell that stock. Before an IPO, a company's ownership is limited to its founders, early employees, and private investors like venture capital firms. The IPO is the moment that changes everything. It is when the general public gets their first real shot at owning a piece of that company. Here's a simple way to think about it. Imagine a fast-growing technology company that needs money to expand. Instead of going back to the bank or to private investors, it sells ownership shares to the public through an IPO. Everyday investors buy those shares, hoping the company grows over time. The company gets the capital it needs to scale, and investors get a stake in the business. That's the core exchange happening every time a company goes public. Now, here's the part that really matters for understanding why companies actually choose this path. According to experts at firms including Schwab and Cherry Bekaert, companies go through an IPO for a variety of reasons. The two most common are raising capital for future growth and providing liquidity for existing shareholders, meaning the early investors and employees who have been holding shares for years finally get a way to cash out. But there are other powerful motivations too. Going public boosts a company's brand visibility and credibility. It allows a company to use its publicly traded stock as currency for acquisitions and employee incentives. It broadens access to a diverse base of institutional investors, and it makes future capital raises easier and more efficient. So how does the process actually work from start to finish? According to sources including Chase and SoFi, there are several key stages. First, the company selects an investment bank called an underwriter to advise it on the IPO and handle the distribution of shares to the public. The underwriter plays a critical role throughout the entire process. Next comes due diligence, legal filings, and financial disclosures. Before any IPO can move forward, the U.S. Securities and Exchange Commission, the SEC, must review and approve all documents. The company files what is known as an S-1, which is an initial registration statement containing detailed financial information about the business. This document is publicly available, so any investor can read it before deciding whether to buy in. After regulatory approval, the company goes on what is called a roadshow, a series of presentations to major institutional investors, where company leadership pitches the business and gauges interest. This helps determine the final IPO price. Once the price is set, shares are distributed, and on the agreed-upon date, trading begins on the public exchange. From that point forward, anyone with a brokerage account can buy or sell shares of that company. But the process does not end on day one of trading. There is another key mechanism most people do not know about, and it is called the lockup period. According to financial sources including SoFi and Wikipedia, a lockup period is a predetermined timeframe, typically between 90 and 180 days, during which company insiders and early investors are prohibited from selling their shares. The purpose is straightforward: to prevent a sudden flood of shares hitting the market right after the IPO, which could crash the stock price. The lockup agreement, required by underwriting banks as a condition of managing the IPO, gives the public market time to absorb the initial share offering and develop a stable trading range before insider supply enters the picture. Investors should be aware of this mechanism because when the lockup period ends, there is always a chance of increased volatility as more shares become available. Now let us talk about the risks, because there are real ones. According to Fidelity and TD, investing in a newly public company can be financially rewarding, but profits are absolutely not guaranteed. Historical data shows that annual returns on IPOs have varied widely from one year to the next. IPOs can come with added risk and price volatility, especially in the early weeks and months of trading. Not every company that goes public delivers the gains early investors hope for. Some surge, some stumble, and some take years to find their footing in the public markets. So what does the IPO landscape actually look like right now? According to data from legal and financial research firms including Cleary, Gottlieb, and EY, the U.S. IPO market has been on a meaningful upswing. Approximately 202 companies with a market capitalization over $50 million priced IPOs in the United States in 2025, compared to 150 in 2024. According to EY, the U.S. IPO market saw deal count and proceeds increase by 27% and 38% respectively compared with 2024. Technology-driven companies, particularly those specialized in digital infrastructure and cybersecurity, consistently priced at the top of their ranges and delivered strong post-IPO performance in 2025. Some of the standout listings from 2025 that financial research firm DFIN highlighted included a major medical supplies manufacturer that raised $6.3 billion in what was described as the largest offering since 2021, a digital banking fintech company that debuted with a multi-billion-dollar market cap, and a stable cryptocurrency issuer that delivered strong performance after going public. The technology, media, and telecommunications sector led issuance overall, propelled by strong investor interest in artificial intelligence, according to EY's market analysis. Looking ahead to the rest of 2026 and beyond, the picture is even more compelling. According to research firm AlphaSense and multiple market analysts, after a long period of stagnation, markets are bracing for what some describe as the strongest IPO environment since 2021, driven by a convergence of lower interest rates, narrowing valuation gaps, and a massive backlog of private equity-backed companies under pressure to exit. According to reporting from sources including EquityZen and Value Add VC, the 2026 pipeline includes more than 25 major venture-backed companies targeting public listings, with several highly anticipated names in fintech, enterprise software, and AI infrastructure. According to AlphaSense documents, at least one enterprise software company is considered a top IPO candidate with a recently established valuation in the 9-figure range. According to financial analysts, a healthy IPO pipeline is essential to the broader capital ecosystem because it allows private market investors to achieve liquidity and recycle capital into innovation, while providing public market investors access to high-growth businesses that have increasingly remained private for longer. There is also a broader democratization trend worth noting. According to reporting from industry sources, digital platforms are expanding retail investor access to IPO allocations. Technology-driven brokerage services are making it easier for smaller, everyday investors to access shares that were historically reserved for large institutions. That shift is meaningful. It means IPOs are no longer just a game for Wall Street insiders and hedge funds. Increasingly, they are accessible to regular investors who do their homework. So to bring it all together, here's what you need to remember. An IPO is the moment a private company opens its doors to public ownership. It is a financial milestone that can unlock massive capital for companies, liquidity for early investors, and opportunity for everyday people who want to stake in businesses they believe in. The process is tightly regulated, involves multiple steps from underwriting to SEC approval to lockup periods, and carries genuine risk alongside potential reward. The current market environment shows strong momentum, and the pipeline of companies preparing to go public is drawing significant attention from analysts around the world. As we move through 2026, watch for updates on whether market conditions stay stable enough to support the large wave of anticipated listings that have been building up. The outcome of those listings will shape investor sentiment and capital markets for years to come. If you want to stay informed on stories like this every single day, follow this channel right now and hit the notification bell so you never miss a thing.